chip design firm ARM out with earnings for the first time since it returned as a public company. That was back in September. It beat expectations for revenue and adjusted earnings per share in the second quarter. Shares, as you'll see, under pressure at the moment. This is more about the outlook for the company. Best person to speak to about it, the ARM CEO, Rene Haas. It is great to have some time with you. And look, you're back trading it kind of where you priced on the IPO at the moment. I'm looking at a 51.20 at the moment. Tell us a little bit about the ongoing weakness in the industry when it comes to mobile, because you've been diversifying, but why is that not bearing fruit in the here and the now?
Yeah, thank you, Caroline. We had a record revenue quarter, which we are thrilled about. ARM has never done $800 million in a quarter. And we also raised our yearly guidance. So we're very, very confident about the outlook going forward. The stock's a little noisy, I think, based upon timings and things of that nature. But, generally speaking, what we're seeing is our royalty business has increased 3 quarters in a row. And what we're hearing from our partners that we're in the trough in terms of the overall inventory and getting better. And our licensing business is really strong. So as a result, great quarter, and we have raised our yearly guidance.
Okay, the context there is clear, and I'm interested about perhaps the AI focus that you've been having. There's been licenses for potentially a bit lumpy at the moment when it comes to companies wanting to deploy your technology within their AI offerings. I'm interested in when that becomes big volumes. When does that become more dependable rising royalties, do you think?
Yeah, so I think one of the things we saw this last quarter in terms of our increased licensing activity was companies looking to invest more to address this demand for AI and AI everywhere. I think the general perspective was that you need more and more compute technology. What exists in systems today is not good enough. More is needed. So I think across all markets, we're going to see AI find its way into the end product. So for us, 70% of the world's population uses ARM. It's literally impossible to do an AI application without us. And we think over the next several years, it's going to drive great growth for us.
And for that, R&D is needed. And I go back to the fact that you sort of said there's noise around the share price. That's kind of the conundrum of being a public company, is the fact that you are a business that needs to spend internally, you need to innovate, you need to invest, but you've now got these short-term goals that in public investors want to see in terms of revenue build, in terms of profitability. How are you finding that tension as a publicly traded company with ultimately a more demanding public investor base?
Yeah, and as mentioned again, we had record revenue in the quarter. Our licensing business was up over 100%. So what that says is companies are increasingly spending money on developing products that have ARM inside. And based upon that and the royalty outlook improving for the year, we did raise our guidance annually. So as I mentioned, we're very, very confident about the year ahead. As far as the balance between R&D and meeting goals and things of that nature, it's something every public company CEO or even private company CEO has to consider. So I don't think we're in any different bucket there.
Welcome to our Bloomberg radio and television audience worldwide, speaking to ARM CEO Rene Haas. Yes, the eagle-eyed out there would notice, Rene, there's a discrepancy, right, between the cautious outlook for the current period and then this kind of full fiscal year boost you had relative to the kind of guidance during the IPO roadshow. What accounts for that discrepancy? Why short-term worry, but kind of confidence that longer term you're going to start booking, particularly on the licensing side?
Yeah, so we've just returned to the public markets, and I think we've got some time to help teach the outer community about how our business works. Our licensing business is both a combination of timing and ratable revenue in terms of when we can actually recognize the revenue. We have great visibility into deals. We have great visibility in terms of revenue profile, which is why, again, we're very, very confident in the year. So inside the quarter, our licensing tends to be lumpy. Yes. Something might happen one month versus the next. But in the main, we're very, very confident and have great outlook in terms of when and if those deals will close.
Rene, ARM is still mostly a smartphone story, highly cyclical, low-margin market. You made gains in data center and auto. Can you tell us when ARM will stop being mostly a smartphone story?
I think I can tell you that today in terms of mostly. We were Probably 60% of our revenues prior to the acquisition, maybe more, were tied to smartphones. Today, it's less than half. So we are not mostly a smartphone company anymore. Our royalty revenues in the last quarter were up 20% in cloud and 20% up in automotive. So we have greatly, greatly diversified. And that's really a combination of both a very, very focused strategy to do so and the pull and demand for ARM technology driven by power efficiency. These megawatt data centers cannot afford to add more and more energy. And at the same time, your automobile running off a battery, it's a computer on wheels, needs to be very, very efficient as well. So the trends are in our favor, and we've also made the investment in the specific products. So as a result, we're seeing very, very strong growth across these other businesses. And I think you can say that today, we're not a smartphone company.
30 seconds left, Rene, which is always a joy for a CEO to hear. But I'm interested in London listing anytime soon?
London listing anytime soon. Nothing that I can talk about specifically today. Something we're considering down the road, but nothing specific I can tell you today.
ARM CEO Rene Haas, thank you for joining us.
Thank you so much.